Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Okay, happy Monday everybody. Today's video will be very economic and finance heavy. As we start the first week of 2023, we have received the first preliminary data for December. The numbers, as anticipated, show a poor final month of a tough year for the Chinese economy, savaged by zero COVID, global demand shocks and instability, an ongoing property crisis, and, in December, the start of the largest COVID outbreak the world has seen to date. Let's first go through some of this preliminary data for December and then look forward to what 2023 could be, perhaps even permitting ourselves to be cautiously optimistic. December, unsurprisingly, was very bad for the economy. China's sudden U-turn on zero COVID, as we have seen, meant a massive wave of infections, which is still ongoing. Economic activity, especially in services, dropped to their slowest pace since February 2020, when Wuhan and large parts of the country were locked down. According to National Bureau of Statistics data published on Saturday, the official Manufacturing Purchasing Managers Index fell to 47 in December from November's 48, worse than already pessimistic estimates. We remember a number below 50 represents a contraction in activity. The non-manufacturing index was even worse. A Bloomberg survey of economists estimated a poor 45. However, the official index showed that activity in the construction and services sectors declined to an incredible 41.6 from 46.7 in November. If we exclude February 2020, this is the worst performance on record. Then there were services, which were frankly horrible. The services PMI fell to 39.4 from 45.1 in November, the fourth consecutive month that it has contracted. China's home sales continued to slump in December too. According to preliminary data from the China Real Estate Information Corp, the 100 biggest real estate developers saw new home sales drop 30.8% year-on-year in December to 677.5 billion yuan. $98.2 billion, worse than the 25.5% decline we saw in November. And this is despite sweeping government plans to rescue the sector. As we remember, China's economy was already in dire straits in November as a failing zero-COVID strategy choked the dynamism from the economy. The reversal of zero COVID in December created a temporary collapse in economic activity as hundreds of millions of people caught the virus and hundreds of millions more stayed at home to hide from it. 2022 was a truly devastating year for the Chinese economy. Excluding the first year of the pandemic, GDP in 2022 is estimated to have grown at the slowest pace since the 1970s. Indeed, it only grew at all due to trillions of yuan of government stimulus. In 2022, the youth jobless rate reached a stunning 19.9% official height. It's likely that 2022 will mark the first time since 1990 that China's economic growth falls behind the Asian average. However, as we now move into 2023, especially as China opens up once again, there are some reasons to be cautiously optimistic for the next 12 months. While pre-pandemic levels of economic activity is unlikely, and while deep long-term systemic challenges remain, at the very least, China should see stabilization in 2023. Economists see an increasing possibility for a faster and stronger rebound later in the year. After a likely slow start in the January to March period, that is Q1, growth is projected to pick up to 4.8% for the year, off a low base in 2022. Morgan Stanley, UBS, and Nomura Holdings Inc. have all revised up their projections for China's 2023 growth since the abandonment of zero COVID. Quote, "It is certain that China's economy will rebound in 2023. The question is, how much?" End quote. It seems that China's policy pendulum has finally swung away from controlling the spread of the virus towards supporting economic growth. As we have observed, the policy environment is now firmly pro-growth for the next 12 months at least. At the mid-December Central Economic Work Conference, which we followed closely at the time, policymakers prioritized stable growth above everything else. Let's discuss how 2023 will likely be much better than 2022. Hey guys, if you enjoyed the episode, don't forget to hit that like button. For the 50% of viewers who are not subscribed, if you do like these episodes and you'd like to support the channel, subscribing is a big help as well. And as always, for those who can go the extra mile and be part of the community that keeps this channel sustainable, Patreon and Buy Me a Coffee links are in the description below. As always, thank you so much everybody for the ongoing support. So where will this growth in 2023 come from? Well, it likely will not come from exports. Demand from the world's three largest importers of Chinese goods, the US, the EU and Southeast Asia, will likely not be strong in 2023. There is also a question mark above the property sector. Policymakers have decided to rescue the industry and prop it back up, kicking the issues of deeply needed reforms and a likely property bubble down the road for a few years. And while the supply side can be restored, it remains to be seen whether the demand side can be. Quote, regardless of what actions are taken, a return of home buyers to the market will not be imminent. It will take time for public confidence to be restored and for households to adjust their family wealth plans. End quote. And, quote, as the peak of the COVID outbreak hasn't passed, the economic recovery remains very weak and home buyers' income outlook hasn't recovered. We expect home sales to recover in the second quarter at the earliest. End quote. The property sector will indeed be a wild card in 2023, which we will follow closely. So, we ask again then, where will the growth in 2023 come from? The answer to this question is two major areas. One, a likely short-term but powerful surge in pent-up demand from households, and two, debt-financed government spending. Over the weekend, the chief economist at Zhongtai Securities pointed out that in the first 11 months of 2022, domestic consumption's contribution to GDP growth was 52.4%, sliding from 57.2% in 2019 before the pandemic. As income growth slowed, people have been saving more. This is a long-term problem, as it makes rebalancing more difficult for policymakers. However, in the short term, it likely means as China opens, we will see a pop in spending similar to what we saw in the developed world after those economies put COVID restrictions behind them. Economists remain divided, however, on the specifics of this. Xing Ziqiang at Morgan Stanley expects private consumption to become the main driver of China's economic recovery in 2023 as life returns to normal and income growth is revived. However, Nomura's economists warn over the weekend that household consumption will not recover to the same extent as what we saw in developed economies, as Chinese incomes were hit much harder and for a longer period of time, that is, 3 years. As such, they predict some short-term consumption recovery, but savings rates to remain higher than pre-pandemic levels. However, what economists do agree on is that China is expected to maintain strong fiscal spending in 2023. As we follow closely these last few weeks, Beijing has committed itself to accepting deep deficits in 2023 in order to stabilize growth, and we may well see more special purpose bonds. We did a deep dive into this last week. Quote, China will increase borrowing through treasury bonds and regular local government bonds to provide funds to bolster people's livelihoods and consumer spending. End quote. The deputy governor of the People's Bank of China recently observed too that, quote, monetary stimulus in 2023 will be at least as strong as 2022. End quote. These monetary and especially fiscal measures are expensive and unsustainable, however. Beijing's top goal will be to restore market confidence. We will see how they do as we follow the country closely through 2023. Bloomberg writes that investors in the stock market, at the very least, are expecting a better 2023 than 2022. The outlet writes that the Hang Seng China Enterprises Index, which tracks Chinese firms listed in Hong Kong, just suffered a third straight year of declines, a record losing streak since its inception in 1994. The slump in 2022, quote, was accompanied by spiking volatility that was the worst since the global financial crisis and ranked the highest among major benchmarks in the world, end quote. Combined losses from stocks traded on the mainland and in Hong Kong reached almost $4 trillion US dollars. But despite all this, the outlet writes, 2023 is shaping up to be a better year. Renewed economic optimism and attractive valuations have prompted a growing number of Wall Street banks to become more bullish on Chinese stocks. Quote, for COVID, as brutal as the pivot looks, it is a short-term pain in 1 to 2 months and long-term gain for consumption and industrial activity in 6 to 9 months. End quote. Analysts argue that Chinese valuations appear cheap at about 10.6 times its 12-month forward earnings estimates. The MSCI China Index is less expensive than both its emerging market counterpart and its own 5-year average. However, the Bloomberg analysts warn, whatever happens in the stock market, it will not be a smooth ride. Quote, given the challenges from a messy COVID-0 exit to lingering US-China tensions and a looming global recession. End quote. Others agree. Quote, the setup for China equity going into 2023 is looking good, with odds still towards further upside, but I don't expect a smooth ride. End quote. But whatever the nature of that ride this year, we will continue to follow economic, political, and geopolitical developments here on China Update, and I hope you guys will join me on that ride. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. I will see you all tomorrow.